We are definitely in a special time right now, coming off a inflation induced by pandemic, quantitative easing, and government stimulus checks. In this video, we're going to talk about how retail investors should navigate today's market environment. So right now, the monetary policy is still very hawkish. Federal Reserve is hoping to continue reducing its balance sheet. And even though the QT has been slowed, right, according to the latest FOMC meeting, the policy rate, on the other hand, is still very high. It's still at the highest point of this hiking cycle at 5.25 to 5.5% range. Now, the high interest rate have traditionally been putting pressure on the asset value, but the current market environment tells a different story. Despite the Federal Reserve's substantial rate hikes, both S&P 500 and NASDAQ Composite are hitting record highs. Even though the high yields on the risk-free assets, right, such as the Treasury bonds, they're risk-free because it's guaranteed by the U.S. government, right? They should lead investors to allocate a larger portion of their portfolio than usual to safe assets, right? Because the rates are higher than usual. So, however, the AI-driven technology sector is so attractive to investors right now, it overcomes that obstacle, making investors believe that the potential return of the American tech sector can significantly outweigh the risks. So the new investment strategy I think is going to work well in this environment is called the 60-40 strategy or 60-40 portfolio. But you may think this is actually a very old strategy, which is true, but there's some modification to it. So the traditional 60-40 portfolio, the portfolio is divided into 60% equity and 40% bonds, right? So instead of buying bonds, which are usually long-term, right? Long-term bonds, you're going to buy Treasury bills or cash equivalent ETFs, right? In Canada, there's a lot of ETFs that invest in, they have access to major banks, high interest savings account. They can actually give you 5% annual rate, right? So you're going to invest in those, either those high interest rate savings account, which gives you like 5% interest rate, or you're going to buy T-bills, right? The short-term Treasury bills or Treasury bonds. So your money are equivalent to cash because your money don't get stuck in Treasury bond for many years, right? So this approach mirrors what Warren Buffett is actually doing with Berkshire Hathaway, because Warren Buffett really emphasized on the safety and the yield of the short-term T-bills. So currently, the short-term T-bills are offering 5.38% annual return. So it's making it very easy for retail investors to buy and hold, right? And the remaining of the portfolio is going to be going to tech stocks, right? So it's going to be pretty much the mega cap or large cap growth stocks, mostly technology, mostly driven by AI, right? So that 60% portfolio can be done using a very simple strategy, just by invest called QQQ ETF or QQQM, right? So the retail investors don't have time to look at the annual report, the 10Ks, the 10Qs, just by QQQ, right? It's going to rebalance as every other quarter. So as a long-term investor, even if, let's say, a year later, Apple is going to go down the drain, it's going to be NVIDIA becoming number one, you will still benefit from it through QQQ rebalancing, right? So this strategy, I think, remains a very balanced strategy between stability, right, through T-bills, and growth potential through the investment of QQQ or AI-driven large cap growth technology stocks. So now the question becomes, how many percentage of your portfolio should be in the T-bills and should be in those equity market? Well, even though I said 60-40, that's just the name of this strategy, right? Your cash and cash equivalent can be 50%, right? Or it can be 30% and you have 70% stocks. Right? It all depends on the market outlook for the future. But the problem is, we as retail investors, we definitely don't know how the market's going to go in the future. But one thing we know for sure is we have access to Warren Buffett's Berkshire Hathaway's 13F report, so we can see Warren Buffett's stock portfolio. We could use that as a reference. So right now, if you look at this picture, we can see Berkshire Hathaway have 34% of the portfolio in cash and cash equivalent, meaning T-bills, right? And then it has 63% of the portfolio in equity securities, right, like stock market. And it has about 3% in fixed maturity securities. So those are going to be bond and treasury bonds. So it's going to be longer term fixed income. But as you can see, this class of asset has been declining throughout the past 20 years. So we can kind of ignore this. But if we add the two things up, right, the T-bills and the long-term bonds together, we have about 37%, right? 37% of Warren Buffett's portfolio is in fixed income. So is this strategy timing the market? Peter Lynch famously said, far more money has been lost for investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves, meaning that people who try to time the market, they end up losing more money than the recessions themselves, right? So is our strategy, we just mentioned, right, allocating a significant portion of portfolio to fixed income, short-term fixed income asset, considered timing the market? Well, to a certain degree, you can say, sure, it is. But I think it's more about being conservative in your approach and prepare for a wide range of possible outcomes, right? Remember, in the new strategy, the majority of the portfolio is still in the aggressive large cap growth stocks. So to me, the strategy is not timing the market. It's just a defensive approach or a practical approach of time in the market. It's a little trick we do to help retail investors to be able to hold on to their long-term stock holdings and don't do any irrational stuff. Right? What's actually timing the market is when the investors decide to sell off all their equity positions in anticipation of economic downturn. I've seen a lot of, on my other YouTube channel, I've seen a lot of people commenting about selling the entire portfolio in the year 2022, right? Because 2022 has been a painful year. Even in the second half of 2022, there's people commenting about selling the entire portfolio. So as a conclusion, this strategy is designed to adapt to various economic conditions and outcomes, right? In a thriving economy where the job market stays hot, unemployment rate stays low, inflation stays at the 2 to 3% range. GDP continue to grow, right? This approach or portfolio strategy is going to capitalize on the market rallies through substantial equity exposure, right? But on the other hand, if the economy condition deteriorates, right, which is very possible because we have seen that a couple years ago, we see the 2-year, 10-year Treasury yield, they inverted, right? So there is a incoming recession, we just don't know when. So if we do have a recession coming because you have a big allocation of your money in T-bills and fixed income, that part of your portfolio is definitely protected, right? And that part of portfolio will serve as a strategic reserve, right? When the stock market price goes low, you take money from that reserve to buy stocks at a discount. And eventually the market is going to recover because if you look at the long-term trend of US stock market, it always goes up, right? So when the market recovers, right, it's going to give you an enhanced return. Okay, thank you very much. Please don't forget to subscribe.